conference organized by the Central Bank of Armenia and Better Policy project around developing Mark II frameworks for monetary and macroprudential policies, specifically designed to avoid dark corners, or at least that is what the panel will be about. And it again includes central bank experts that you've seen before, such as Douglas Lexton, director of the Better Policy project, but also a host of new experts today, such as Hovhannes Kachaturian, who is the Deputy Governor of the Central Bank of Armenia, Shalva Matrashvili, who is the Chief Economist at the National Bank of Georgia, and David Aikman, who is Professor at King's Business School in London, where he is also Director of the Qatar Center for Global Banking and Finance. Professor Aikman previously has worked at the Bank of England and was an advisor to the US Federal Reserve. So again, plenty of expertise to talk about some of the following crucial issues. Building on an earlier panel, question came up: how can central banks further enhance monetary policy as well as macroprudential policy frameworks? Then also, what lessons can be drawn from practical applications of FPAS Mark II in addressing complex economic challenges? And then finally, we want to explore some advanced strategies to avoid dark corners in policy making. So maybe let's start with the first statement. So how can central banks further enhance monetary and macroprudential policy frameworks? Is there anyone who would like to start on the panel to take that question?
Certainly speak about the macroprudential side of that, if you'd like me to kick off.
Absolutely, sounds great. We haven't heard about macroprudential yet, so that's great. Focusing on monetary policy so far.
Okay, so maybe that's a nice compliment. So I guess the first question is like, what do we mean when we talk about a policy framework? Maybe you have discussed this already. To me, this means an understanding of the objectives we're trying to achieve with policy, the toolkit that we have available at our disposal, an understanding of the transmission mechanism of those tools to the objective, and then possibly also the actual decision-making framework itself. Who reaches a decision, who needs to be consulted, how is it communicated, and so on. And I think it's my sense is while a lot of progress has been made in macroprudential policy, people have been doing this for about 10, 15 years at this point. When I say at least after the financial crisis, I know things were done that were called macroprudential policy ex post before the crisis, but I think they were a little bit different in my view. So I think a lot of progress has been made, especially in terms of narrowing down the appropriate set of tools that should be used. So I sense that there's a degree of consensus around the core elements of the toolkits, around bank capital requirements, measures that seek to limit buildups of debt, particularly in the household sector. And I think there's also been a lot of very, very good research that's been looking at the transmission mechanism of these tools. So I think we have a much clearer understanding now than we had a decade ago about how these tools operate. So there are a couple of big ticks there, but I would say on the kind of negative bits of the framework development, there's still, to my mind, there hasn't been enough work trying to articulate the actual objectives we're trying to achieve. And I think that probably wasn't a big problem in the early days of macroprudential policy, where we just had a big financial crisis and it was pretty clear that we needed to have tighter standards in terms of bank capital or in terms of mortgage debt limits. But for some time now, we've reached something akin to a steady state for these policies. And I think it's not clear what macroprudential policy is trying to do beyond kind of getting us to that steady state. So I can say a little bit more about that if you're interested, but I think this kind of area of articulating the objectives is something missing. And then I would say, related to that, perhaps, I think there has been a bias towards inaction in terms of the use of these tools. Forgive me, I don't know the details of the situation in Armenia. I'm currently at the Central Bank of Ireland. That central bank has used these tools quite a lot and quite aggressively. But I think many other countries, the US, I would even say the UK, big European countries really haven't used these tools. There's been a lot of lip service, but I don't think they've actually done an awful lot with the powers they've been given. So maybe there's some opening remarks for you, and happy to kind of expand on different aspects of that.
So, David, when you say the Bank of Ireland has used these tools quite, aggressively, and whereas others have not, what do you mean by that? Because as I understand it, very often these are sort of ratios that are set at a certain level, and then also makes sense to just leave them at that level if you found the right level, right? So, how is the Bank of Ireland different then?
Yeah, it's where they've put the level. So in Ireland, for instance, the maximum loan you can get relative to your income is 3.5 times. And that's quite a binding limit. The maximum loan to value ratio is 80. So they were deliberately set in quite a stringent way. That reflects the scale of the crisis they had in Ireland 15 years ago. Whereas in the UK, we had similar policies in place to this, but they were deliberately implemented to be not binding. So they were meant to be kind of backstops that in the event we have a future big cycle, maybe they would bind then, but they're not kind of impinging on borrowers' credits demand at the moment. So that's specifically what I mean.
Yeah, okay, that's clear. Yeah, that's a great opening. Are there any panelists that would like to respond to that?
May I, just as a opening remarks, Armenia on the central bank law level introduced the financial stability as the second or even the first mandate of central bank. And since then, it was some 15 years ago, since then, of course, we developed instruments, but the many challenges still exist in terms of, starting with very definition of financial stability, from the coordination with monetary policy. There are different instruments. There are instruments affecting both of them. They may be in conflict in terms of the goals of monetary policy and financial stability. They may be in coincidence. And we also, as David said, referring to any figure, any target or level of over-indebtedness, capital buffer, liquidity buffers, you name it. And in all these tasks, we are doing lots of researches, lots of trials and errors, looking after other peer countries and what's going on, and what's the recommendation coming from Basel is applicable for us. But it's a journey that we play. I cannot say that these models are that well established as the FPAS Mark 1 and Mark 2 now at central bank. Probably it's justified because the topic is more complex, and we don't see, frankly, many countries who are presenting the final and the best model or models that should be used, being it semi-structured model or dynamic stochastic. What is the underlying models? We run different research initiatives, or it is the credit growth trend which should be controlled and followed. Or, for example, in central bank, we developed an index which we believe is good for signaling whether we should go upper in terms of counter-cyclical buffers or go down. We had research and come to a neutral level of counter-cyclical buffer in order to show the market that we can go up and can go down and can have certain level counter-cyclical buffer in standard situation for a longer run. Of course, it is also a big matter about the price of financial intermediation. Unlike the monetary policy, which is clearly defined that, for example, in case of Armenia, already we have 3% target rate. We know that 0% is we're missing the target. 6-7% we're missing the target. In the case of Macroprudential, there is not such a thing that you are overshooting or undershooting. Big problems when emerge, everybody sees, but the cost that you impose on the financial system, it's not visible. It's a debate how overwhelming these buffers are, or they are okay. So all these make this topic complicated. So looking forward to clear up some of them today.
All right, thank you. Shalva, can you add something from your experience in Georgia?
Yes. Hello, everyone. I had some connectivity issues earlier, but it's working fine. I hope you can see me and hear me well.
Absolutely.
Thanks. So a couple of comments from my side, and of course the usual disclaimer applies, and now it applies twice because I'm at the kind of the crossroads of my career. I'm finishing my chief economist position at the National Bank of Georgia and then joining the IMF. So disclaimer applies to both of the institutions. And my comments would be on the Hovhannes mentioned the usage of forecasting and policy analysis systems, either Mark 1 or Mark 2 for the monetary policy purposes. And I think since the global financial crisis, financial stability policy has been evolving in a direction that it also needs something similar, like in a way, formalizing the processes, formalizing the combination of models and interaction between staff and policymakers. Something very similar that has been kind of a practice for monetary policy, I think could be useful for financial stability policy for a couple of important kind of reasons. One is that financial stability policy became more cyclically dependent since the global financial crisis. We've introduced several instruments that depend on the measure of the business cycle, that depend on the analysis of where we are, where is the economy now, where it's kind of heading towards, and what our instruments, how our instruments should be adjusted to achieve the financial stability policy objectives. So all these questions are very similar to monetary policy questions. We ask exactly the same questions. Where are we now? Where the economy is headed towards? What our instruments, how our instruments should be adjusted in the future to achieve our monetary policy objectives. So it means that in a way, monetary policy modeling and forecasting and policy analysis frameworks and that of financial stability policy have kind of a dissimilarity. And I think they are kind of they should be converging towards this kind of idea that formalizing these processes for usage of models, interaction between staff and policymakers to incorporate policymakers' views into scenario building and so on. I think that kind of will help financial stability policy as well. So I think that's kind of my lesson from what I've experienced. And it also helps, the second point is that it also helps on the communication side. And one simple fact that I've observed, maybe it's not true for every country, but for many countries that I've observed, including Georgian case, is that when we try to and kind of follow these counter-cyclical macroprudential policies, it's very difficult to be kind of ex ante, especially when it comes to credit booms, because of some important lags. One lag is that we need some data to observe whether we have a credit boom that kind of needs financial or macroprudential response. Then we know this Basel III approach in counter-cyclical capital buffer imposition that we need to enact this 1 year in a kind of we need to decide and publish our kind of intentions to increase the capital buffers 1 year in advance. So that's another year. And then it still needs some time before these decisions affects the real economy. And by that time, credit boom could very well already be turning into credit bust. And if we are kind of tightening our macroprudential instruments during a credit bust, that's kind of something that no central bank wants to do, because then the credit bust will be fully kind of linked to central bank decisions, and everyone will be talking about the central bank being the reason of that. And of course, that's not something we want, even if it's not true. Kind of optics and communication challenges are there. So, which means that we need to do something kind of similar to monetary policy, doing some kind of a forecasting and policy analysis, coming up with scenarios, and then if we kind of adopt similar approach to what we are trying to adopt in monetary policy, namely kind of communicating scenarios and communicating which scenario is more relevant as of today, and we are taking preemptive actions today, which means that the future may not look like exactly as our scenarios, but at least we're minimizing the cost to the economy in the more relevant scenario. So that's kind of a robust monetary policy type of approach. Similar can be useful, and I think it's in practice kind of either implicitly or explicitly is incorporated into financial stability policy. But this kind of FPAS Mark II approach, formalizing this, I think this can be useful for financial stability policy as well, because of these communication challenges. We need to be ex ante, but we don't know how credit kind of dynamics will evolve in the future. So that kind of a scenario-based forward guidance, something similar to financial stability policy, can be not only useful for policymaking, but for communication challenges as well. So I think that's kind of an important reason for me. The experience shows that this is important reason for me to somehow see this kind of a convergence of monetary policy as well as financial stability policy towards using this kind of forecasting and policy analysis systems, especially Mark II, which incorporates this scenario-based forward guidance into actual policymaking. I think that will be a welcome kind of evolution from my perspective.
Thank you, Shalva. I think that probably sounds like music to Dog's ears, and I will ask him about it next. But I just one question. When you said about optics that it might look bad for the central bank to be seen as sort of popping an asset bubble, I was just wondering, how does that jive or like compare to, I mean, central banks seem perfectly willing to be seen as sort of slowing down the economy to prevent inflation, and that could lead to a recession, and that seems fine. So I'm just wondering, why would it be more problematic for central banks to be seen as asset bubble fighters?
Well, because it's difficult to pinpoint the exact reason why this kind of asset bubble popped, and if someone kind of blames the central bank for stopping kind of economic growth when it didn't need to, then that's a problem. What we need to do in that case is provide a counterfactual scenario saying that even if we did nothing, the kind of a bubble would have continued kind of a couple of years further into the future, but then it would result in even bigger crises. But of course, kind of a credibly showing this kind of counterfactual scenario is difficult, because by definition it's counterfactual. You can only do analysis, and either somebody believes it or they don't, and that's kind of the challenge.
If may I add?
Yeah, absolutely.
Yeah, David, after you.
No, I insist. You go first.
No. Just on this on this very topic, I can bring an example of real estate bubble, sort of defined by Central Bank of Armenia. What is the situation? You have a booming market. You believe that the market prices, real estate prices, are overvalued. You introduce LTV, and you strengthen the LTV ratio. And there is ongoing talks about stopping. There are two things in parallel. One is just you are killing business, which you can live with that. The other bad thing is that you are just explicitly saying that prices are overvalued by X%. And we decided to make this communication. It was a hard decision to make this communication to prevent market from further overheating. And this may affect, and this is responsible thing. It is much harder to show counterfactual figures further, whether you were right or wrong. And you should explain how these gaps should close, because there is a gap that you see in your head. There is a bubble, and there may be variety of cases how these gaps are closed. And at the end of the day, you are approximately 100% of times wrong, and they come back with forgetting all this counterfactual analysis that you were predicting something, made very tough decisions, stopped the lending, but at the end, nothing is there. And on the other hand, you are having at the end of the day issues in the real estate market, and you are again wrong. So it's much better. It has consequences on deposits. It has consequences on people losing their entire wealth compared to the inflation being a little bit higher or lower. So I think the responsibility is much higher there.
Okay, yeah, convincing. David.
I just add a couple of my thoughts to this interesting debate. So, firstly, Joey, your question about how's this different to inflation picking up, and I think the fundamental difference is people like bubbles. So it's kind of much more unpopular to kind of step in and do something when asset prices are increasing. Whereas when inflation is getting out of control, we've seen that that's an unpopular thing to happen, and there's a lot of support for the central bank to step in. So I think they are fundamentally different. I might react to something that Hovannes, I'm sorry if I'm mispronouncing your name, said, which is, I like framing these in terms of stress scenarios rather than saying the market is overpriced by a certain amount. It's a very similar statement, but in a stress scenario, you don't have to say what the right price is. All you're saying is, what if prices were to fall 10 or 20% of whatever you think a plausible overvaluation is? What impact would that have on the financial system? And I think that's where stress testing has been very influential and powerful. And that's a kind of a way of avoiding you pretending like you know what the right price is, or even a sense that you're trying to target a price, which is a very difficult thing to do. So that's what I would advocate, this kind of stress testing, stress scenario approach. And then, Joey, something you asked at the beginning about, don't we just set these tools at the right level and leave them? And I think there is a sense in which the balance between how much of the heavy lifting should be countercyclical versus just there the whole time. I think that's an important debate to have. And the lesson I would take from the practice of macroprudential policy is we should try and get more in the kind of, it's always there. So we don't wait till there's a problem emerging. We just kind of set buffers at the right sort of place that they don't need substantial adjustments. Because Shalva, I very much like the way you frame the analogies with monetary policy, but I am quite conscious that there seems to be a lot more frictions in actually getting countercyclical adjustments to these tools in practice, and we should kind of recognize that in the framework, I think.
That's really interesting, David. So can I summarize it or rephrase it just to that monetary policy is dynamic, right? You respond to what's happening in the world, but you're saying actually maybe macroprudential policy just should not be dynamic at all. It should just be set at the right level, at a fairly strict level, presumably. And that would that would have a huge impact on this whole discussion of, do we need a framework that is anything like FPAS Mark II, right? Because if it's just set it at the right strict level, then you don't need to do scenario analysis and all of that, because there's just one correct level, essentially.
I wouldn't go quite as far as you put it, and you're obviously simplifying kind of, to make the message clear for people. I think you still need to do this cyclical analysis and understand whether risks are greater than you factored in for. But I think we should be trying to move more of the regulatory tools into kind of an always-on position, as you've been putting, as you explained. But I just wouldn't go all the way to the corner.
Okay, fair enough. Yeah, I put that maybe a little bit, controversial to hopefully see if one of the panelists will take the bait, take the other position. Let's see. Does any of the panelists want to react?
A quick point. Sorry, yeah, just a quick point. What David mentioned. I think that's kind of an important point, and I agree that there should be kind of some difference between monetary policy and financial stability policy, because financial stability is so much more nonlinear and so much more difficult to kind of understand ex ante. And I think that that's kind of why recently we've Basel also introduced this positive neutral rate for the countercyclical capital buffer, so that you kind of are prepared always, but there is still some margin for which you need this kind of a countercyclical analysis. And thanks.
Okay, thank you, Doug. What is your take on this
Well,
debate?
I'm going to come at it a little bit from a modeling perspective, and that's partly because I knew Shelf has been working, I think, pretty intensively trying to extend the earlier models that we developed that have endogenous money creation. So I'm referring to our 2014 paper, where we emphasized endogenous money creation, not with a lot of heterogeneity, but the basic idea of the paper is that excessive credit expansions and asset price bubbles, particularly in the housing sector, are the leading causes of the seeds of a crisis. And that then leads me into a question to David, because he now said that we understand more about the instruments. We didn't use them before the GFC, but we understand more about the transmission mechanism. Their big issue is that we can't specify the objectives very clearly, and so on. But in that paper, for example, the only thing we looked at is the level of capital requirements. So the argument was that the level of capital requirements in a model with endogenous money creation should be able to affect not only the medium term and short run effects of money creation in the economy, but it should do it in a long run too. So it's like capital requirements are an incredibly powerful tool that theoretically and empirically, well, that's why I wanted to ask him. In 2016, we took that and added LTVs and so on, something that was specific to the housing sector and so on. But my first question is, in that 2014 paper, not only did we consider the level of capital requirements, which of course would have long-term effects on the level of debt and money in the economy. And that sort of raises the question, do you want to, could you think about just having a measure of the safe level of debt? Okay, this is very, very important that something like this not be a hard constraint, but that you think in terms of an objective function. Okay, so you say in China, for example, its debt to GDP ratio, private sector debt to GDP ratio doubled, went from 100 to 200. In the first instance, could you just say, well, let's get the policymakers to agree that maybe the safe level of debt is X. And then when it comes to doing the modeling, we can then ask, well, how powerful the instruments need to be able to achieve something in the neighborhood of X, not X. Who cares about X? What you want to know is how far you are away from X, because the idea is the risks get bigger and bigger the more you increase from X. So in that paper, capital requirements was the thing that we went at because we thought that was the most powerful instrument for controlling debt and asset price bubbles. So my first question is, David, do you agree with that? That like with monetary policy, we think of the interest rate, as being the number one principal instrument, or its path more precisely, not the damn short-term interest rate. Who cares about that? The expected path of interest rates that affects long rates and exchange rates and stuff. So could we think about building a model now, because you said that we understand more about the transmission mechanism, where we'd have a loss function for macroprudential policy, and we would just specify that deviations squared from some desired, think of it as safe level of debt. Now that's the first question. Second question is asset prices, because I said, it's an excessive credit expansion and an asset price bubble, principally in the housing market. Sometimes, even though the problem isn't in the housing market, if the economy is booming, land is supplied inelastically, and so obviously the bubble, usually ends up showing in the housing market as well. But maybe David or the others could respond. Another way of putting the question is, what policy would you have used before the global financial crisis to try to mitigate, to try to prevent it's a very specific question. What instruments, how would you have used them? Shelva's point is, the crisis was September 15th, 2008. At what point would you, transition from, would you be pretty aggressive in 2005, 2006, 2007? You start seeing property prices decline. At what point do you kind of take your foot off the pedal because for fear that you might actually burst the crisis by tightening those financial macroprudential instruments?
Thank you, Doug. Can I answer straight away? Is that okay? Wonderful. Yeah, thanks for the great questions. Super interesting. So I think I've got something to say about all three of those, and you may or may not agree, but let's see. Firstly, I'm very supportive of the way you framed the question. Should we be trying to write down a loss function and a model? Notwithstanding my points about trying to get more of the action into structural policies versus cyclical, I think it's a really important endeavor, and there hasn't been enough work trying to write down what a loss function would look like. Some of my work has focused on the idea of GDP at risk, which I know your colleagues at the IMF have worked a lot on as a potential way of thinking about the objective function. And I think the way I would interpret the arguments of the loss function that you put forward in terms of debt levels and real asset prices especially, they seem to me to be like intermediate objectives that would then tell you something about the ultimate goal. So I think that all seems to be going in the right direction to me. The first question you asked specifically, I think, was, are capital requirements the right tool? Are they the powerful tool? Are they akin to the interest rates? I don't think so. So I think capital requirements work quite differently. And this is my reading of the evidence on this so far. Capital requirements, I think, have a very weak transmission to credit growth, particularly in the states of the world where you want that transmission to be large. So if you're in the middle of a credit boom and banks are making lots of money, they can very easily meet an increase in capital requirements because the levels we talk about are trivially small in terms of height. We allow banks to be very, very levered, and it's quite easy for them to just retain a little bit of extra profits to meet an increase in capital requirements. So I can send you papers that kind of support that position, but I think these tools are much more powerful as builders of resilience in the system. So if you think the banking system is undercapitalized and it will amplify a shock because it's very, very highly levered, which is, I would say, the big problem that happened in 2008, then capital requirements are very good at that, but they just won't do very much to the size of the bubble that's kind of developing in the economy. I think tools that have a much more direct impact on credit, especially, are things like LTVs and loan to income limits and the whole the set of policies that are in that domain, because they very directly target the effective demand for credit. Even those tools, I don't think, have a very powerful transmission to asset prices themselves, house prices in particular. So I think I could point to quite a few countries that have put in place those measures, but they still have volatile housing cycles. What's happened is they've managed to divorce the house price cycle from the credit cycle. So you end up with squashing down on the amplitude of credit cycles, but you still get quite a lot of volatility in house prices. And I'm trying to remember your third question, which I wrote down as what instruments, but I forgot.
So if you were thinking, like, taking that as given, how would you think about preparing a plan that would have mitigated the global financial crisis? So but I have a little follow-up, and you said, so I agree with you, the LTVs that's our 2016 paper. We showed that those things can be powerful instruments. But what I want to know is, what would you have done with the benefit of hindsight to develop a framework that, say, in 2005, what kind of capital requirements would you have had? Would they have been building up buffers at that point? 2006, 2007, property prices start to fall a little bit. And then, of course, you have a scare in 2008, and then you have the Lehman Brothers collapse on September 15th of 2008. So I want to know, kind of like, with the knowledge that you have about the transmission mechanism now, how would that framework adjusted instruments, and what would those instruments have been?
So, Doug, I'm in a happy position that I've written a paper on exactly this question, and I will find a way of putting it into the chat here so you can all take a look. And it's a paper in the Journal of Economic Perspectives in 2019 that is titled, would macroprudential policy have fixed the last crisis or solved the last crisis? And we try and approach the question both from an ex-post perspective, what do we know in terms of tools and that sort of thing, but also what's plausible that could have been done at the time. And it seemed to us writing that paper that, for instance, the countercyclical buffer in the United States could easily have been increased, putting aside political issues, just from a technical, did we understand the risk and was there enough money in the banking system to kind of finance this? The countercyclical buffer could have been risen to a number between 3.5% and 5% without too much trouble. About that much money was paid out in dividends to bank shareholders from 2007 onwards. So that's one very clear policy. And I think also housing related tools could have been put in place. We think the most powerful tool in that context would have actually been something like a loan to income ratio, because a lot of incomes were not being verified. So just the requirements to verify the income of the borrower would have already curtailed a lot of the riskiest lending that was happening in the United States at the time. But I'm happy to share that paper. One of the kind of things that struck us was there's a discussion that you can see in the Fed minutes in 2005 talking about housing prices being overvalued. So it's not that people were not aware of the bubble evolving here. There was a good understanding of that. I think people just misunderstood how much resilience was in the banking system at the time. If you look at those minutes, you see statements like, banks are meeting their Basel requirements, so this is not a problem. And we didn't really understand how little capital was actually in the system. So I think a stress test as well would have kind of uncovered some of those issues. Hope I've answered your question.
Yeah, thanks. That was perfect. Thank you.
I do have, in addition to that, you mentioned capital requirements, loan to value, loan to income ratios, but I didn't hear you talk about liquidity requirements or reserve requirements. Is there a reason for that? Are they powerful?
I think they are more powerful tools than capital requirements, but they are also much harder to calibrate. So the kind of fundamental problem is, if you can get liquidity from the central bank, why do you need to kind of squirrel away liquidity in good times yourself if you can borrow? So why not just pre-position collateral with the central bank and then draw on that line when you need it? So it's kind of hard to kind of pinpoint where that balance should be between self-insurance and public insurance through the central bank balance sheet. But I think in terms of the transmission of those tools, they are very powerful, because you're forcing banks to hold assets that, well, until recently weren't offering a very high rate of return on their balance sheet. So part of the paper that I referred to does talk about liquidity requirements as well. We have a calibration for that. So I think they would have been part of the story for the GFC, just given the scale of the issues. But I think central banks are also much more willing to lend to the banking system now than they understood they needed to do in 06, 07. So that's been another structural change that's happened.
Yeah, so if there is sort of liquidity, what's it called? Like, I understand that central banks have sort of changed their regime, right? It used to be liquidity scarcity, and now it's sort of liquidity surplus. Is that, I don't know if that's the correct term, but are you referring to that, like that regime interacts with these liquidity requirements or reserve requirements?
Yeah, it's another aspect to it. So it is true that central banks have just injected a huge quantity of reserves into the banking system. So there is a lot of liquidity already in the banking system. But I was referring more to the case that if there is a crisis of some sort, like we saw with the issues in the United States 2 years ago, central banks are now very kind of quick off the mark in terms of lending on very generous terms. So if that's happening, it's a little bit less clear kind of what the role of forcing banks to hold liquidity ex ante actually is. So I think that's the kind of the delicate balance really. But we still have the Basel liquidity measures in place, the LCR, the NSFR. I guess we're not seeing a lot of countries going beyond that for macroprudential reasons. That's another observation, I suppose.
Yeah. No,
Even though I
this was
think they
actually
would be
what I was
comfortable.
referring to, or was trying to at least, that if you are like the Fed now after the SVB crisis, willing to lend out freely extra reserves, then, reserve requirements matter less, right? Because you're just increasing the amount of reserves in the system on demand. Anyway, Shelva and Hovannes, how would you prevent the financial crisis, and what are the preferred macroprudential tools to do so?
Yeah, if I may, coming to questions of Doug. First of all, about the target and the profit function, so-called, what we are following in terms of when we are making macroprudential policy, GDP, it's okay that in the long run the cumulative wealth and GDP and whatever economic potential GDP, all this good. But I think that policymakers are very much focused on the big changes. What I mean, big deltas, when it's booms and busts, and at the end of the day, to booms and busts, you are getting on the higher level of GDP at the end of the cycle. I think policymakers mostly would prefer lower level of output, but with less boom and bust, because it's also a political thing. It's just a remark regarding what we are targeting for. Coming back to the Doug's questions about debt level, or what is the cause and how we measure that. I agree with all that David said, but a couple of things about, we don't forget about endogenous effects. We are setting parameters for debt, for capital adequacy. Then in the market, something happens which bypass all settings you make. Some financial innovation comes, and the financial intermediation are bypassing banks. Different variety of instruments are there. So I agree a little bit with David that capital adequacy per se, it's not solving all problems, at least. And also you are making the settings, and you think that you are preparing from the capital adequacy and liquidity point of view for the next crisis. You think that you are ready, but then fundamental things are changing in the market infrastructure, market structure. Remember about the individual investors that are running into the market, taking big exposures, and at the end of the day, they are amplifying risks. So that the things are dynamic, and the level of debt in terms of individual, it's pretty much straightforward. But in terms of companies, if we take into account Miller Modigliani, all this story about how companies are raising their funds, it's a little bit philosophical things. It's coming from debt, what kind of debt, or partially equity. What kind of equity is that? It's placed on the market or from the retail investors, or what kind of equity is that? So there are lots of questions in that. And I would rather speak about not the level of debt, but some big mismatches, imbalances, or if you want, inequality even, which is important to look after. How much accumulated mismatches between the income source and coming back to the topic of overvalued real estate, David, it was exactly the thing that we want to talk, probably not successful in that, about the gaps, not the overvalued prices, but the gaps. We see some gap, some intrinsic values coming from the wages, rental rates, etc., and the value of property. And we have some theory, of course, there. We see some gap. There's a big mismatch in Western world, in our world as well, when the landlords are a group of people and the tenants are another group of people, or mortgage borrowers and asset holders, and there are different groups of people. And when financial instability comes, some of these groups are less prepared. And finally, about the GFC, what could we do before 2008, or what can we do now to prevent GFC 2.0, because it can come still. I don't think that the buffers would prevent that. There are multi-level answers on the question. It's about the discipline, market discipline. It's about having short crises. If you have short and small crises, it prevents you so pumping all the markets in order to having more and more in terms of asset prices. It's bad for it's accumulating problems for the next crisis. It's also about education. It's about concentration of risk. We are talking about the Microsoft, which monopolist in some area, or Google or Apple, whatever, but there are also concentration of risk. So probably some sort of antitrust actions towards the risk accumulation, because what Lehman Brothers, couple of guys gathered together and created a big concentration of risk around them, and some model risk or whatever it is, personal risk, key man risk happens, and it's making a big problem. Now I think that from the big tech companies, this key man or key company risk is very crucial. Probably they are too powerful, but the impact will be dramatic in some areas.
All right, thank you. Finally, Shalva.
Yes, so I think in terms of kind of choosing or sequencing instruments, so if we think about financial stability, it's of course financial stability is kind of important to maintain for non-financial sector as well as for financial sector. For non-financial sector, I think these borrower-based instruments, they are relatively more flexible. Kind of in my experience, as I've seen, especially in case of Georgia, it's easier to use, and it does kind of can quickly lead to this kind of a slowdown of credit that you want to see. So that's kind of a more or less successful, I think. And when it comes to financial stability of financial institutions, I think, of course, the financial crises are much more rare issues than some strains in non-financial sector, but they are much more kind of consequential, and that's much more important to make sure it is done right. And for financial sector stability, I think when it comes to choosing between like capital, kind of a capital requirement and liquidity side, I think in everyday kind of a day-to-day kind of a stability, it's all about liquidity, because we know that almost by definition, financial crisis is kind of when financial liabilities of banks, which are informationally insensitive short-term debt, when they become kind of information sensitive. If someone questions the deposit side, liability side of banks, which are kind of a fixed price liabilities, when someone questions this and try to convert them into something else, then that's by definition financial crisis. And that happens, that means that deposits become illiquid. And that's why I would say that from day-to-day perspective, financial stability is all about liquidity. But from a longer-term perspective, we know that liquidity side and capital side, they are interlinked. And one way to kind of ensure liquidity of deposits is for central bank to always step in and provide the lending of last resort if there is conversions from deposit to something else, either cash or to kind of leaving one bank to another bank, so that making this first bank kind of financially kind of fragile. Then central bank can ensure this. But then if central bank is kind of taking credit risk on its balance sheet, then it's just a fiscal operation that's kind of a bailout and something we want to avoid. In that case, then we do need capital requirements, and therefore making sure that capital requirements are also at the kind of right level. And that's why liquidity may be important from day-to-day perspective, but making sure that capital requirements are also at the right level from a medium-term to long-term perspective is also important. And also there is a link between, like, even if we take the central bank out of this picture, there is a link between liquidity and then capital. And then an extreme example would be if we require banks to hold 100% liquidity. So let's take like an example of narrow banking, 100% reserve requirement. Then this means that all the lending will be done by capital. So that 100% liquidity in this kind of extreme example is 100% equity, 100% capital requirement, because this kind of a liquidity is only for kind of a short-term deposits and loans, which using this risk-weighted asset kind of approach is the only part of, becomes the only kind of a part of the bank's balance sheet that bank is required to hold capital, so that it's kind of a technically 100% liquidity requirement is kind of similar to 100% capital requirement. So there is some link between liquidity instruments as well as capital instruments. So that's why I would think from day-to-day perspective, it's important to make liquidity side, liquidity instruments kind of adjust and be kind of fine-tuned. But we also need capital requirements from short, medium-term to long-term perspective. And that's why I think we also need models in which liquidity risk and credit risk are modeled together. In many of the models, even the nonlinear ones that are supposed to do financial stability analysis, in most of them, liquidity risk is modeled separately, and then credit risk is modeled separately. And I think combining them together should be kind of useful for understanding how to sequence and how to use these liquidity instruments versus capital instruments. And by the way, that's some of one work where I'm kind of trying to build such a model, and hopefully we will get to something kind of useful, and then we'll let you know. Thanks.
Right, that sounds very interesting. One thing that I picked up in all of your contributions was in different ways you referred to monetary policy, either through, giving out a lot of liquidity, or as Hofanes sort of alluded to, bailing out and thereby sort of increasing the risk of future bubbles. And Shalva talked about it in a different light as well. If we're talking about a macroprudential framework, and we've been talking the whole day about monetary policy framework, and what I really sort of noticed is that they seem to be like seen as these two different frameworks, one for inflation, one for financial stability reasons. But that there's also been a lot of discussion about how these two interact. Should is monetary policy also responsible for financial stability and perhaps also vice versa? Could you also maybe comment a little bit on the interactions between these two frameworks? Like if we make a macroprudential framework and a monetary policy framework, can we actually do that? Are these two different things, or do they interact, or do they interact just a little bit, but that's okay and we can just ignore that?
Can I take a stab at that? Because I used to argue with Bill White all the time. He used to argue that we just needed higher interest rates before the global financial crisis. And I would say, Bill, no. The way that we think about monetary policy is that it can affect things in the short run, but it can't affect things, real things, in the medium and long term. I've changed my position on that quite a bit through the experiences of going through the global financial crisis, because of all the unconventional monetary policies, and I'm including in that large-scale asset purchases, as well as unconventional forward guidance that drove, was telling people that they're going to keep interest rates low for a very long period of time. That the combination of those two things drove term premium down to zero. And even when I look at a 10-year bond rate today, which is about 4.5%, there's only about a 50 basis point term premium built into that. So I think these really aggressive monetary policies have resulted in an extreme underpricing of risk in the economy. David, when I look at the monetary policy report the financial stability report for the U.S., it doesn't seem to scream the kind of risks that I see. Going back to some of the thoughts that Hovhannes said, that when you're fighting crisis situations, you make the bubble bigger and so on. So I'm totally in that camp. In fact, I think we're in a very dangerous and narrowing corridor, because when we get into those situations, when we're at the effective lower bound, they stimulate the economy, and that results in enormous increases in asset prices and debt, and that supports economic activity. The problem is that if interest rates rise, the critical threshold, given the high level of debt, where people realize it's not sustainable, that critical threshold for debt gets smaller over time, and so on. So, I mean, that critical threshold for interest rates. So let me give you a good example. COVID. We get COVID, February, March, asset prices fall. There's a 35% decline in global equity prices. They then stimulate, and that increase in asset prices rises and contributes to the U.S. household balance sheet by over $50 trillion, over 2 times the value of U.S. GDP, and so on. So I would say, asset prices are, equities are on Mars. Property prices are probably on the moon. And that is, there's an incredible bubble there. Now, the question is, do people start spending out of those higher property prices and out of those higher equity prices? When they spend, that usually results in higher leverage. Housing is a normal good. It has an income elasticity and wealth elasticity greater than 1. So that usually results in a buildup in debt when you have really high asset prices. So I think that there's a very large possibility that we're going to have another GFC over the next 5 years. And it could be a result of a number of things. One is that people realize that fiscal policy is unsustainable and interest rates rise. And then, of course, we have concerns about monetization in the requirement of inflation to stabilize it, which pushes interest rates even higher. But I'd like to get some views by other people on the panel about how serious they think the risks are. And if they think they're really serious, why are financial markets not pricing any of this stuff in? And I want to come back to David a little bit. People love bubbles. but don't they hate bubbles bursting even more? So please, I'd like to see everybody's views about, how dangerous of a situation are we in right now?
Yeah, who wants to
Can I
go
go
first? David? All
Is
right.
that okay? Great question. Thank you. I think there's a simple answer for why there's such a disconnect between risk pricing in markets and the kind of quote unquote real world. And it's the fad, isn't it? So people, the institutions I speak to are not interested in risks that they think the Fed will deal with through asset purchases. And that's kind of conditioned behavior over a long period of time. So it's kind of not surprising that that prices don't reflect those risks. I think the disconnect is particularly extreme at the moment. I think there are certainly reasons to be concerned. There are, a whole litany of risks you could write down, including the ones you identified, Doug. I do think, like one important lesson from the crisis is having like a fall in an asset price per se. It will cause a slowdown in the economy, but it won't necessarily trigger a financial crisis. What triggers a crisis is when there's loads of leverage that's underpinning those asset prices. So be it kind of very thin layers of capital in the banking system or in other kind of core intermediaries. And that, if you wanted to tell a slightly more positive story, you'd say, well, it doesn't look like the banking system is as fragile as it was in 2007. I mean, quite the contrary. There's been over 15 years of work trying to kind of make the banking system more resilient. So I find it hard to think we're kind of in a situation anywhere near as bad as 05, 06, even though the world looks very risky. Primarily for that reason that I think steps have been taken to ensure that the kind of core bits of the system aren't as levered anymore. But that's not to say I'm kind of sanguine, because I agree with your general point that it looks like the world is riskier. It's curious in that regard that we're not in a macroprudential tightening phase of kind of trying to build more buffers in than the neutral or the positive neutral levels, as Shalva described them. I think that's a kind of a failing of macroprudential policy right now. Banks are very profitable. Be a good time to increase buffers, I think. I'll stop there.
Yes, and
yes,
go on. Yeah. Okay. So just a quick comment. I agree with David. I think the banks are much more kind of well prepared for any kind of difficulties in the financial system going forward. The only kind of difference is I would say that these fiscal concerns are a bit kind of difficult at this point, because it's of course difficult to understand where demand for kind of treasuries come from, because these are kind of unobservable, so they depend on demographics and all sorts of other things, demand for safe havens and then safe assets. And they very well could have increased, and more kind of likely have increased relative to last kind of several decades, which means that there is a kind of a chance that these high debt levels, government debt levels, can be maintained because of demand for safe assets. But there's also this possibility that if this demand declines because of some kind of fears, because some interest rate risk premium or term premium rising up, and then the price of these safe assets declining, there's this kind of a possibility, even if it's not kind of the most likely one, I think is still frightening. If that happens, then even if with banks better prepared than before the global financial crisis, this could still be kind of a very difficult kind of a crisis. And then that's why I would be kind of from a risk management perspective, I would be concerned about this, trying to kind of be a bit more conservative at this point, either from fiscal policy perspective, or from financial stability perspective, or even from monetary policy perspective for that matter, then you would be with low government debt levels, even with equity prices being high. If fiscal side was not generating any risks, I think it would be much easier with financial system, with banks being prepared for any downturn in equity prices.
Doug, it's $1 billion question. We don't know the level of risk, and if we just think about the sources of big shocks or the next financial crisis, it can be like born internally, like a financial infrastructure globally or regionally is just not working, regulation, etc. It's another story. I don't think that we have something that is will come from the financial sector itself, or it's coming from other places, and your system and regulations are just not appropriate anymore. And it's like a tectonic plates. There is some pressure between different parts of the world and different forces, and at some point of time you don't guess that time, they are just breaking some small rock where keeping all this in stable and sometimes its stability is breaking. I can just mention some. We talked about all of this during this couple of days. This slow motion bombs that we have, some major things that are pushing us, like it's demography, it's climate things that we provoke some movement of people, or whatever is that. It's about rising of decentralized finance without control or with some interesting consequences, AI itself, and deglobalization of global trade and finance and whatever you say. And we can be lucky in this couple of years or 10 years if that forces cancel out each other. For example, AI and demography can cancel out each other and we have not big things there, or they may be some resonance and we have a perfect storm, and financial system with its old school, with its current settings will not be on place, and the big thing will happen. Fiscal is from the short-term perspective. I share the concerns about fiscal discipline from different countries. We have some bad signals, but moreover, let's think about United States. We can lose zero risk instrument anytime soon. It's not only about the thing that this is a bipartisan attitude. Every next administration is increasing the deficit and the debt level, and whether this is sustainable or not. And also because of this deglobalization, when we think about in next time, it may be not the only safe haven. And probably we should calculate what is the credit risk of United States government, because many things may so this time may be different. So in that sense, if we think linearly, the buffers are probably better than in 2007-8, but these big forces, we may be not ready for them.
Wow, that is quite quite worrying. Actually, I think that would make it the perfect time to see if the audience has some questions for the panel. We roughly have 15 minutes left, so if anyone in the audience, you could just raise your voice or put up their hand if you're on Zoom, or just turn on your mic. Just let me know.
Sure.
Yeah.
I'd like to ask people, I mean, it was mentioned, a couple of people have mentioned they think the banking system is in better shape than it was in 2007 or 2008. But one of the things I took away from 2007 and 2008 is that nobody, including supervisors, especially supervisors, knew what the shape of the banking system was in, right? They didn't understand all those CDOs, all those three-letter things that came, SVPs, all that kind of stuff, SPDs, all the three-letter stuff that came out at that time, right? That was a failure of supervision, in my view. They didn't understand where the risks were, right? So, for example, the largest insurance company in the world went bankrupt as a result of a banking crisis. Who would have guessed? Are you sure that banks are, how sure are you that banks are in better shape? You know, the Silicon Valley experience, to me, was very worrying in the sense that those banks looked to be in really good shape. They met all their capital requirements. Everything was fine. They weren't in very good shape. So that's my question. I mean, I'm not very sure they're in such good shape. There might be all sorts of stuff going on under the hood that we don't know. I'd like anybody interested in commenting on that possibility.
Thanks. That's a great question. David actually left, I just want to say. He had another appointment. So this is either for Havanas, Shalva, or Doug.
So I agree with that. Absolutely. I don't think these financial stability reports have factored in the possibility of scenarios where basically income is down. Okay. So their analysis is very biased because they look at things like debt to GDP ratios and things of that nature. The problem is that the denominator in that ratio might not be safe. And so one can imagine situations where interest rates go higher, income goes down, and I think that's, you know, that I don't think those calculations are being done. I don't see them in the financial stability reports. They had no scenarios of higher interest rates, and we know that there is one non-linearity that we can count on, and that is interest payments are equal to the effective interest rate times debt. And as interest rates get higher, or as debt gets higher, those effects become very nonlinear and so on. So the capital losses on the banks, if interest rates were to rise, any of those banks that made mortgages at 2.8%, 30-year mortgages, any of those banks that took on government securities at even lower interest rates, if we were to go into a higher interest rate environment, and if it were recessionary, that would result in humongous capital losses on those bank balance sheets. So I think you know, I just don't see that. If I saw the scenarios in the financial stability report that covered those things, I wouldn't be as concerned. But the problem is that they're not there right now.
Can I ask a question?
If I may just answer the question of Robert about how we are sure that banks are okay or not okay. We don't know because things are getting more complicated. But one important aspect of that is that what kind of risk we are expecting from them, from the credit risk, interest rate risk, etc., this whole list of risks. I don't think that we should expect risk from that part, probably from cybersecurity part, which is one morning we wake up and the bank don't respond to us, there is no app working, and all this may cause big problems. And the other problem is in the head of people. When normal standard depression or recession starts, what is the behavior of people? They cut their spending. It's bad thing, but we can solve with that. It's a deflationary spiral. It's bad thing, but we can solve that. But what if in the heads of people, businesses, and individuals, banks are not the place where I should keep my money and bring my money and save my money in government securities or other instruments, but rather something else. If this kind of asymmetric risks, I think is much more important to look after rather than like interest rate risk or other conventional risk in banks.
Right, thank you. There was also another question from the audience.
Yes, I have a question. I'm Oleg. You don't see me actually because I'm behind the camera, but I want to go to the very first part of the discussion when Shalva Mkhatrishvili mentioned some difficulties regarding implementing macroprudential policy that we don't see in developing the framework for implementing macroprudential policy that are not the case for monetary policy. He mentioned that, for example, we should have some data to understand where is the current situation regarding the financial stability. For example, do we have a credit boom or not? Sometimes even when we want to act with the macroprudential policy, we can have some lagged effects, like we can, for example, decide to increase the countercyclical buffer that will be implemented in 6 months or even in 1 year, and at that time maybe it will not be needed, for example. And I want to address these concerns and ask Shalva and also Hovhannes, you know that commercial banks prepare their strategic development plans for the coming 3 years. And I also want to mix the FPAS Mark II framework to my question, like, what if banks actually respond to a central bank, try to implement this risk management approach and design their strategic development plan for the upcoming 3 years, implementing this risk scenarios, so that this data about their balance sheet for the coming years can have some endogenous information about whether the economy will be booming, like the credit will be, we will see credit boom in 1 year. Will this data also help to understand what will happen in 1 year? Would it help us to make more right decisions about the macroprudential policy right now and design a framework that will be simultaneously effective as FPAS Mark II, and also help to mitigate the lagging effects. And also, I'm just wondering, for example, if we decide to increase the countercyclical buffer in 6 months, then somehow we assess that we do not want to do it. Can the central banks immediately cancel that increase, like after 6 months, or it also, so should it be symmetrical, like we should decide to do it again in 6 months, or can it be implemented immediately? If my question was right. Sorry for my English, like I don't know if my last question was understandable.
Yeah, Shalva, go for it.
Thanks a lot for the question. So I think this endogeneity of banks' behavior and the central bank's decisions about its policy instruments, I think that is kind of a complicating factor. That's true for monetary policy. That's, of course, is going to be true for macroprudential policy. If banks anticipate that given for example, given a positive credit to GDP gap, central bank will be tightening capital requirements so that banks, in anticipation of this, they cut back lending kind of in advance to retain more capital and be prepared for the higher capital requirements in the future, makes the forthcoming capital requirement tightening unnecessary. I think that's kind of if I understand correctly, that is the kind of a difficulty, and I think that's true. But at the same time, that's the reason in monetary policy world. That's the reason why we communicate. We want to achieve a given result without much changes in the policy instruments. And if something similar spills over to macroprudential policy, I think that could be useful if banks endogenously react to our threats of changing countercyclical policy, countercyclical capital requirement instrument. If they react endogenously to these kind of credible threats, then they will be doing all the heavy lifting without us needing to change the instrument that much. And I think that will also kind of address David's kind of concern that it's difficult to do countercyclical macroprudential policy, so it's better to to have something more structural, like some correct level of capital requirements without changing this requirement much. And if our communication, if our scenario-based analysis or whatever we use in macroprudential policy makes banks more reactive to makes banks realize our reaction function in terms of capital requirements and incorporate this reaction function in decisions, their own decisions, anticipating our future kind of a reaction, makes financial system quicker to adjust to the recent developments in credit to GDP gaps, for instance, and any other indicator, and therefore makes the usage of instruments less needed, so that even smaller changes in capital requirements could have the same effect, and therefore that can actually be useful. I think that would be kind of my kind of how I would anticipate a successful communication could help in macroprudential world.
Right. Thank you so much, Shelva. And
just a comment, sorry. Just before Hovhannes starts, I'm just I just want to create a room for tomorrow's discussion on so going deeper with the FPAS Mark II and commercial banking, and just I imagined what will happen if this risk-based approach also banks implement in their decision-making process. And as Shelva said, so if commercial banks start to endogenously react, so to assess some scenarios, assess how the central banks will react to these kind of developments, have this institutional potential to forecast some future economic dynamics and try to guess what will be the policy, what policymakers will do, and do it beforehand, like ex ante, reacting to some future developments and creating a room for more effective policy making for central banks. So that's why I think that this risk-based developing this risk-based approach also in commercial banks will be very important. And also that's why I think that central banks being more transparent and communicating their decisions with financial markets participants is very important for the future. Thank you.
All right. Thank you so much. We have maybe time for very quickly Hovhannes' response.
Yes. In ideal world, what you are referring to as if everybody are making the risk management, we don't need to make a risk management because they do it on behalf of us. Of course, it's a joke. They, of course, follow central bank and they try to guess what's going on. They try to read well what central bank means in the next cycle. But, you know, they are businessmen. They make risk management, but their profit function may be very different somebody may value very much the volatility of the earnings and equity price and profit, whatever. The others may be much more like casino bankers. So it's different. It's the market, and it's the mix of people, how the behavior and sentiments in the market. It depends on how that's how our triggers works. If everything is rushing for the profit, it's the mood, then everybody are just gaining the profit, will be not listened. If vice versa, everybody are in fear, we are pushing down the requirements, again it will not work as well. So communication is very important. It's normal that the market participants are very different in responding to central bank triggers.
That's a great conclusion, I think, to this amazing panel.